Move that the board approve the minutes of the May 22nd, 2025 and August 7th, 2025 meetings of the Texas PSF Corporation Board as provided.
A motion in a second. Objections.
Mr. Chairman, good morning, members. I'd like to touch on a few strategic plan highlights first, and then I will segue into comments. I think that sets up nicely for the next item, which will be comments from our investment consultants. So I'm going to start on page 13, which is highlights of our particular 6 strategic goals and things that have happened since last we spoke on that. And the first goal of optimizing asset allocation, we have now incorporated in our risk modeling the oil and gas royalty program managed by the General Land Office as a way to understand our total exposure to commodities, not just in the PSF portfolio, make sure that we're not building undue concentrations when we put these two together, because both of these portfolios are for the benefit of the available school fund, and we want to look at that risk holistically. We recently reaffirmed our 5A distribution. Annually we have to do a constitutionally required 10-year test to see what kind of market resiliency the portfolio has to downdrafts in the markets and our ability to continue to make our distributions to the PSF. We passed that with flying colors, and in fact have even more of a buffer than we did the year before. Currently, we are looking at our asset allocation closely in anticipation of revisiting the investment policy later this year, early next, primarily focused on private markets and in particular private equity, which has grown to a target of 20% of assets, and we're likely to recommend a higher target. That's large enough now that it warrants probably breaking it out into 2 or 3 subclasses with corresponding benchmarks for those subclasses. So we'll pick that conversation up with policy discussions in Q4. The second goal of improving portfolio implementation, we have combined all of our public equity operations under kind of one frame of mind thinking, from index funds to active management to highly active hedge funds, all based around liquid available markets. But by consolidating that group, we've realized over $1 million a year in payroll savings. And doing that, we have deployed over $2 billion in our active beta equity strategies. That's kind of another word for hedge funds, where we are moving around both in long and short around S&P 500 benchmarks. That has been a very, very strong performing portion of our portfolio over the last year and a half. It's functioning very well. In further cost reductions, one of the initiatives that we had in the original strategic plan was to evaluate trading costs. We found that our traditional trading costs and just how we buy stocks and bonds was very, very tight and done highly efficiently. But what we found was our foreign exchange trading was done rather inefficiently, where individual managers were allowed to adjust their foreign exchange positions by going long or short different currencies. And we had dozens and dozens and dozens of managers doing this. So many times you would find managers offsetting each other in currency trades. And so we're paying twice to do the same trade. So we've developed a program to net all of those into one single, long or short for desired currency exposure, that has whittled out between $4 and $5 million a year in annual trading costs. Just that one thing. And we get the same risk management that we want at the end of the day, just far more efficiently. We have now implemented what we call a beta overlay program with a strategic partner, the Morgan Stanley. This is just a more efficient tool to rebalance. Like when we're trying to maybe add a little exposure to stocks, or to take away some exposure from stocks, or add and vice versa. Instead of selling the underlying assets, we can simply make those adjustments in the futures market at far lower cost, far more liquidity, far easier to tweak and rebalance the plan. We have finalized the shutdown of the legacy risk management system, the Aladdin system, that was quite costly, and as you all recall, in some of our fixed income portfolio management areas, it actually was problematic. We have shut that down, and we've moved all our risk modeling over to the new BARA 1 system. And kind of our next steps in the implementation is to marry this beta overlay program with this new risk system. So it will really give us very quantitative measures of the impact as we move things on. Yes, sir.
One more time.
The Aladdin risk management system that was provided to us by BlackRock. And a note on investment activity while I'm on this page. So far, 6 months into 2025, we've underwritten about 500 deals. We've approved 40. Those 40 deals total $6.3 billion. It should come as no surprise that the preponderance of that is in private debt and private equity, because we have set higher strategic targets to those places. We are actively allocating money towards them. All of the rest of the allocations are more systematic rebalancing and reinvestment of cash flows and distributions. Contrast that on an annualized basis to 2024, we did 96 deals. So we're, a little bit lower pace, as you might imagine, but far lower in dollars. That 41 billion was quite extraordinary because we were moving both all of the publicly traded internally managed equity program and fixed income program. So we'll highly unlikely we ever see that dollar volume of movement again. Of these 40 deals and 6.3 billion, you could see that without any changes to our due diligence discipline and our risk and return targets, almost half of those investments ended up being done with Texas managers. 17 placements, or 2.8 billion in the state of Texas. Once again, just reflective of the very dominant position the state of Texas has in the world economy, and we've got a lot of great opportunities in the state. The goal of attracting, developing, and retaining talent has moved ahead with greater clarity here in the last 6 months. I'm pleased to introduce to you all, sitting to my left, our new General Counsel, Lane Arnold, who joins us from UTEMCO, and also our new Chief Operating Officer, Nidhi Vasavera, who joins us from a very large hedge fund platform and was, as a matter of fact, a former educator in Texas public schools. These two executives complete the build out of the C-suite. We now have a CFO, COO, a Chief Audit Officer, General Counsel, Deputy CIO. So we've completed the build out of the executive management team. This summer, we launched our largest internship program in our history. And hopefully we will break that record next summer, and the summer after, and the summer after that. We hired 14 interns. One of them, we've offered a full-time employment job upon their graduation, and 9 of the 14 are continuing on part-time through the school year. And we've improved our evaluation process to incorporate what's known as the 360 reviews, Whereas for each employee, we're getting feedback not only from their supervisor, but from their colleagues and from their direct reports to create a holistic picture of their management styles and capabilities. Next steps in the talent goal is to build out the co-investment direct and special situations team. That effort will be headed by Stu Bohart, our deputy CIO. And the training of staff, I've reported to this board earlier that beginning of this year, we launched our comprehensive technology training, doing training in 3 series of classes in Excel and 3 in PowerPoint, along with 2 others in artificial intelligence. We're now rolling into the more soft people skills and professional training. We will be doing a series of classes for new supervisors and middle management development, but also specific leadership and executive coaching for our senior leaders, executive team, including yours truly. And we will be unrolling a series of activities designed to be both educational but also team building activities for our staff as a whole.
Did we partner with a third party for the training?
We did. We used it was a Wall Street one, was it? Or
Wall Street Prep.
well, Wall Street Prep. Wall Street Prep was. We're still evaluating on the management skill sides, probably multiple partners there. The progress related to the goal of communication. Preview to you all last time, a mapping application we've developed where we can map any asset, management relationship, contract, school bond, anything we own, manage, we can plot geographically around the world in ways that are very easy to read and understand. We opened our doors here to host the local Chief Investment Officers workshop at Innovation Tower, sponsored by Goldman Sachs. And we had representative CIOs, deputy CIOs from the TIMCO, TRS, ERS, Municipal Retirement System, Texas Safekeeping and Trust, to name a few, several others, which we, by the way, have had really good outreach and collaboration pretty much on a quarterly basis with all of those sister funds. That's really helpful in the sharing of information, problem solving, market outlook, et cetera, et cetera. So we don't all have to reinvent the same wheel all the time. And in terms of communication to stakeholders, I gave a pretty comprehensive update on the strategic plan and the financial results of the PSF to the Texas Rural Schools Association, along with the Texas Association of School Boards. Met with a couple of think tanks to do the same, to go over in detail all of our progress and planning, that being the Texas Public Policy Foundation and Texas 2036. Along with Chairman Maynard and I did a podcast with the Railroad Commissioner, get some live coverage on our progress, very well received there. As a result of having to carry the water on the board's legislative appropriation request, I naturally had to testify in front of the Senate Finance Committee, the Senate Education Subcommittee, House Appropriations Committee, met with executive leadership staff and the governor, lieutenant governor's office, LBB, as well as one-on-one meetings with a series of leadership in Senate and House, joined with me many times by our general counsel or Mike Gady, Chairman Maynard, and in some cases Vice Chairman Wright as well. So we really, I think, got a long way to creating a consistent story and messaging to the legislature on our plans and our progress. And I think that had no small effect in our LAR being passed as requested by the board. In terms of more targeted communication. We've launched a monthly newsletter to the board. It's called Smoke Signals, where we're keeping y'all apprised of activities and events and market updates intra-board meetings. And we just did the same first ever one for the State Board of Education as well. What we're working on currently is more of a community outreach in doing some partnering, volunteering, teaching at local schools. We're working on some charitable functions that will just kind of help establish our brand as a participant in the local community here. We've been now probably coming up on our 5th town hall meeting in which we have all of our employees participate, and we will have a leader, keynote speaker from one of our strategic partners talking about the macroeconomic environment, trends in investing, that then leads to breakout sessions with subject matter experts from the hosting firm and our different asset management teams to just hold workshops on their respective asset classes. That's been a very good source of collaboration and information sharing as well. The goal of strengthening our corporate governance, as all of you are acutely aware, we have been spending a great deal of time over the last several months in refining and developing a new revised ethics policy that's up for discussion today. And we've been laying out the framework and early drafts of our first ever board governance policy. As a way of, this is kind of a communications item, but also a governance item. We have added to all the members' library on Diligent, and we will post every quarter the independent performance calculations prepared by our custodian, the Bank of New York. So that library will be archived and available for you all to see, 24/7. Should you, have any curiosity about certain things in our portfolio. Next up, I've already mentioned the governance policies and teed up that we will be talking about the investment policy statement in the coming quarters. We have finalized the last part of our internal organizational structure, and probably one of the more complicated pieces of that, and that was our accounting, finance, and investment operations areas. So we retained both Mercer and Alborn Associates, two partners of ours, to do workflow assessment, diagramming, individual personnel assessments, and help us design a more efficient workflow and a more efficient staffing allocation to execute that. Those studies and final reports are complete, and the executive team will be implementing those recommendations over the course of the 3rd and 4th quarter. Our 6th goal on fortifying our internal controls continues to progress after having created the first ever internal audit division and getting our first chief audit officer last year. We've now finalized our first 2 internal audits focused on investment fees and expenses, as well as performance pay plans. We were happy to have the opportunity to promote from within. When our controller announced his retirement, we were able to promote our senior internal auditor, who also had accounting background and CPA background, as our new controller, which not only demonstrates the promotional path for within for our employees, but brings an internal control mindset to our accounting group. So it's kind of a twofer there, if you will. We've completed statewide controls over expenditure processing, in the process of hiring a junior auditor. I skipped over when we moved Alice Felch to controller. Our CAO Fernando identified a senior internal auditor who's on board. Those of you who were in the Audit and Ethics Committee meeting yesterday got a chance to meet this gentleman. And we're recruiting a junior internal auditor as well. Next up, as we head into Q4, we'll be development jointly with KPMG and our internal audit staff and executive team will be our 2026 enterprise-wide risk assessment, which will inform our audit plan for next year. And we're completing this 2024 charge card rebate program and expense. I will pivot back now. If there's any questions on the planning progress before I talk about performance, I'll pause for a moment.
I just wanted to piggyback on Cliff's question about what's the new risk management software?
R01.
R01. What are the differences between that and Aladdin? Is that like highly configured? I mean, can you help
Maybe our chief risk officer would be better.
So one of the benefits is we've had the Bank of Mellon be our custodian for about 20 years. They partnered with a firm called Burgess to handle all of our private markets. About half of our portfolio is private markets now. And we didn't get the level of insight and granularity of all of our private investments through the Aladdin system. So we were actually proxying our exposures through factors and correlations and relationships. And now we actually get to see what we own through all of our funds, all of our commitments, all of our underlying investments, and take a bottoms-up approach and roll it together. So it was a much better system for where we are today versus the decision we made about 10 years ago. And it's a cost savings.
That's it.
Any questions?
Thank you, Mr. Chairman. So performance highlights, and I will talk about the big picture items. I won't jump ahead to the items that NEPC will cover on specific sub-market benchmarks and other macroeconomic data. And I'll just touch on some other items that are not redundant in the information we supply to you. But top line numbers are trailing 1 year return as of June 30th is 8.1%. That compares favorably to our policy benchmark of 7.8. And we can see a very pleasing pattern right now in 3, 5, 7, and 10 years of steady positive performance. It's really huddled around our long-term expected return of our portfolio is about 7%. So you can see that we have been very consistent around that, and we've been consistent in exceeding the benchmarks. These green bars representing excess return. I'll point out what looks like maybe that our excess return is compressing. It's not that the results of the portfolios are getting any less than expected. What it is the changes that the board approved to our investment policy last year took a much turned a tighter screw on a lot of our benchmarks, and we really scrubbed the benchmarks to make them very, very appropriate to the asset classes in conjunction with our incentive performance pay plan that we've said before we wanted to have a higher bar and we would have bigger carrots on much longer sticks, and that higher bar is now graphically reflected here. But there are some very profound things going on in the market, I think, secularly here. Permanent changes. When I reflect on my 40-year career in this, I think we are facing a very different set of markets, and it's going to inform the asset allocation changes we end up recommending to the board this winter. And we know that our peers have long had higher allocations to private equity, private debt, other quote alternative strategies. This board took a half step towards that when we approved the policy in January of 2024. Excuse me, I'm capable. The public markets equities are becoming less and less and less diverse. We've gone from 8,000 companies to 4,000, and the top 10 companies in the S&P now are comprised 35% of the market value. So that market is just shrinking and concentrating, and it's really pivoting to corporate America is using the private markets for both equity and debt finance. In the banking area and credit, we now have the return of embedded systemic inflation that we haven't had in 40 years. And it's not likely to go away. This is really linked to supply chains, trade restrictions, a lot of other, global forces that have changed. And banks who used to play the almost exclusive role in lending to corporate America now are down below 20% of loans to corporate America, 19%, 81% of the credit provided to corporate America is through private channels. So this migration we're making to private equity and private credit might have looked different 30 years ago. Might have looked like we were kind of doing an alternative, investment and enhanced return strategy. But the reality is that is where the market is going. And if you are going to try to invest in a diversified, global way, you have got to be in that market. And these public markets are almost becoming the quote alternative. The final thing I'll have to say about changes we made in asset allocation on page 11, the ultimate proof in that pudding is our improvement in our relative peer group versus other large endowment funds. And those changes in asset allocation, along with the implementation that we've put in place and we're not through with, but we've made significant progress on, have immediately resulted in significant improvements in our relative ranking versus our peers. So the program is working, and it's working as intended. Now, obviously, at some point in time, inevitably, there will be some market crisis, some unforeseen shock. They usually come out of places, that you don't really expect. We did position the portfolio to be slightly risk off going into this spring when we had the real tariff issue blow up. We are slightly underweight in equity. We're slightly overweight in cash. We also rotated some of our equities into broader equal weighted benchmarks and not market cap weighted. That has not helped us in Q2 because despite all of these things, the market's continuing to just march in this arena. But if and when, it's time to pay the piper, these things will come home to bear. But we're not far. We're pretty close to our policies, but at the margin, we're slightly risk off.
Or slightly.
So 500. Jared, you can help me with the percentages.
Yeah, it's about $500 million, or about 1%, and that was about 15 basis points in Q2. Right, so we were slightly defensively postured. We would have we came into this position thinking that tariff were an impact, and we did see that immediately at the beginning of April, and our portfolio actually did well when the tariffs were announced. But in the subsequent, rally back, being underway to discuss costs of about 15 basis points.
Which we will at some time, pivot that back into our overlay program. We can do that, instantaneously and cheaply. But we're not feeling like everything's rosy and we need to be back, risk on plus. That's not our, and I think maybe this segues very nicely. Yeah. I conclude my comments, Mr. Chairman.
Question?
Yes, sir.
Thank you, everybody. Bob, when I look at this chart right here, so versus peers, what is the peer universe?
This peer universe is the Boney universe of greater than $1 billion. So it's, Jerry can give you more color. We kind of look at two of them. We have the top 25 largest endowments, which we use like for all of our benchmarking. This one that comes off the custodian is a little broader.
Endowments and foundations.
Greater than $1 billion. So you're catching some of these 3 billion, 6 billion funds.
And that sample size, I think, is like 55 firms.
So I'm looking at the BMY report as well, and the numbers are a little different. Can you help me reconcile?
You say the numbers.
On page 20 of the PDF report from BMY. May just be looking at the wrong page or comparing apple and orange. Just trying to understand. 1 second. Page number online.
So sorry, it's a little bit confusing, and Rhett can kind of opine on this. The way that they present the percentiles are typically inverted and different than like the way Mercer looks at it, the way that Rhett looks at it. And so we actually take that number and invert it and change it to make the higher number good.
Different scale, one equals best or 100 equals best.
So for example, you know, a 35 would equal 65, if that makes sense.
Yeah, so like. Bear with me here, we haven't seen this in a while, I just wanna make sure I'm reading the report right. The red dot is us on the BNY.
The red dot is the portfolio, correct?
The dashed lines are the breakpoints of the 25th, 75th percentile. So quarter ending June 25, are we the 25th percentile?
We are at the top third roughly. So if you look at that hard line, that would be the median. So we're better than median, so we're in the second quartile. And then if you look at the percentile number, it's the 35th percentile. And here we're depicting it as the 65th percentile. So 100 minus 35 is 65.
As we look at different universes, I'm looking at just different providers. Some will use the scale that 100 equals best and one is worst, and some will use the opposite scale. And so we're looking at two different scales. So one is the reciprocal, the other basically.
Sure, and I appreciate that, but I'm trying to reconcile that now with the y-axis, it's annual return. So wouldn't the top wouldn't higher up be better?
So, and that's why in the picture, we're trying to depict the same picture here. And then in the bottom where it talks about the percentiles are inverted. So you're absolutely correct in that the 3-year on the Boney report, a higher number is a higher return. So we've actually had a better return than the peer group. One other thing is this peer group is they only do gross of fees to normalize it. So if you're looking at the actual return of the fund for this is in gross, but everything we report to the board is in net. And unfortunately, Boney doesn't have a net peer group because they don't want to account for some universities have administrative expenses that are paid outside of the fund, some are paid in the fund. So they try to make it equal so that everyone's kind of having an equivalent apples to apples comparison. So the returns will be slightly different, but we're looking at the percentiles. I know this is new and it's been a while.
So on the year-to-date number, we're like just that hash mark. That's
Right.
like in the bottom quartile is how I would think about that. Is that right?
Correct. So the year-to-date number would be the 6-month period. And this is a 3-year rolling. There's a 3-year rolling percentile chart. Give the board a sense of, you know, we wouldn't typically look at returns over 6 months to be indicative of trend or relationship. Sure. And so we try to have a longer term view to demonstrate the relationship.
Okay. Any other questions?
Sure.
Yes.
Morning, Bob. Just a quick question on you or Jared, or if I'm getting into NEPC. You said we don't think things are that rosy and your number of basis points kind of off of so I guess we have ranges for investments. And how much do you vary when you think things are rosy versus not rosy? How much do you kind of pull the lever one way or the other?
Well, it's one thing to keep in mind is that the portfolio will drift as markets move no matter what. So very simple example, you set this precise 60-40 stock bond target and you have $60 and $40. The next day the market moves, it's no longer 60-40 unless those two markets moved in exact lockstep. So you're drifting away from the target. And then you have to make a decision on is it prudent to allow that drift to persist? Because there's a cost in correcting it. So we're always evaluating where we are versus our targets and overlaying that with macroeconomic views and microeconomic views for the different asset classes. See, where are they at their valuations relative to history? You know, it's a mosaic approach to determine, is this a an overweight or underweight that we're comfortable with letting it persist, or do we want to take action to correct that? And from time to time, we will take action to either accentuate or offset those mixes. And a couple of times in the last year, once in the fall and once this spring and the tariff thing, there was significant changes to the market where we thought now is a good time to make some conscious adjustments, some really forward-looking adjustments. For instance, we got to a point last fall where rates seemed to have kind of hit the bottom of their cycle and were creeping back up. So we started moving duration, maturity in, because as rates go up, the more duration you have, the more risk you have. We would kind of take those chips off the table, if you will. And in coming into this tariff situation, we felt that this could have a suppressive effect on earnings and therefore stocks. And so let's come in a little bit less than target to just give us a bit of a buffer there. But generally, if we have no clear macroeconomic picture, we tend to want to be right at or close as possible to policy. And only when we have pretty big signals that markets are hitting inflection points would we express it. But we do have bands around that we can't.
How big is that?
It varies by asset class. The bigger asset class allocations, of course, have bigger bands than smaller ones, but that's stated in the policy, asset class by asset class, approved by the board.
So you have guardrails
Yes.
for fixed income.
Correct.
Above and below.
Correct.
Got it. Thank you.
Okay, any other further questions?
Yeah, I got a comment.
Yes.
Now, this may be a future project, should be a future project. Just kind of walk us through a 20% correction, what you guys do. I know you've got a plan.
Yeah.
And if it ever happens, you need to.
Matter of fact, this might be a good, future little kind of educational piece we can do for the board, because with this BARA system, we're able to model all kinds of things. We can actually go back and model past crises and say, with this portfolio today, what would 2008 look like again? What does COVID look like again with this one? Or we can come up with just our own scenarios, right? What if interest rates shoot up immediately, 2% and stay there, and model the effect on the portfolio. What's most important to us, first and foremost, is liquidity, right? Making sure that, as we commit to the legislature that we're going to be making these contributions to the available school fund, that we have sources of liquidity no matter what, and that we can pay those payments even, after a 20% downturn. So we do that through not only holding cash, but we're also looking at portfolios that generate natural liquidity, like coupon payments and dividend payments, where you don't have to sell the underlying asset. It could be marked down 20% and not the best time to sell it, but you're still collecting coupons and stuff on it. And so we make sure that we've got a long runway ability to pay this. And I think in some measures,
It's near 30%, right?
Years, correct?
I heard we could withstand 30%.
So for the 10-year constitutionally required tech, we would have to have the whole portfolio go down over 30% before we triggered having to put the brakes on making ASF contributions. And since the portfolio is very diversified, that would probably be something like equity markets fell 50-60%, rates shot up 2%. It would be very draconian, because I think even in the worst of the financial crisis, we were down 18-20 in total.
So we tripped it after the financial crisis.
Yeah.
And it was total fund had a high water mark fall down to 30%. But if you think about the 10-year test being kind of rolling on and rolling off returns, we happened in that lost decade to have two crises occur. And so that 10-year test just incorporated a lot of losses from the tech bubble bursting and the great financial crisis, which in 2010 resulted in us tripping that 5-year distribution. But remember, that portfolio back then was about 75% stocks. So we're way more diversified after the financial crisis. We've been on a 15-year process to diversify the portfolio. And so when we're shocking the portfolio for equity, interest rates, dollar weakness, it would be a massive.
Well, we're able to put a probability on
Yes.
this? Because we look at every asset class and we know the distributions and like, so
We're
why don't
estimating
you tell them the probability
less
of,
than 1%, about 0.5% likelihood that we would expect this to happen. So it's never zero. So it could happen. But the likelihood is very, very low. And when we look at that likelihood today relative to the last 18 years, it's one of the lowest probabilities we've had in violating the 10-year test. So we feel very comfortable about the distribution, the 5A distribution.
Follow up on that, we caught back up within like a
Yes.
year, right?
Yes, correct. Correct.
Jerry,
Thank you.
can you model, sorry. Oh.
Yeah.
I didn't know if he was done. Can you model, it sounds like 2001 to 2010. Could you model that with the
Yeah,
current portfolio?
Absolutely. So that
Would you trip and?
So there's a couple ways we do it. There are the ability for us to take the exact same portfolio today and run the exact same economic shocks back in the tech crisis, the GFC. So we can literally replicate what is today versus what would have happened in the past. The other benefit for us though is we can create our own scenarios, right? So what do we think tariffs are going to do? What do we think interest rates are going to do? What do we think equity markets can do? The dollar can do? We actually move all these variables together. And because the VAR system has that bottoms up look through relationship for all our holdings, we actually get reasonably accurate estimates for how our overall portfolio would be impacted by all these shocks at once.
what I'd add to that, say what's most informative when you're doing this is actually to just move one variable at a time and see what is the effect of the portfolio on this variable, because it illuminates that something that you might think is maybe something to watch has very minimal effect because of a lot of offsets and diversifications. However, the next variable might have a major impact. So that helps you focus on which variables are, have the most risk impact and how are we mitigating this. And this tool allows us to do it in an infinite number of ways.
Us older folks around the table have seen some ups and downs. The younger people don't even know what down markets are, so it's just inevitable. We'll get something down the road.
We'll come back and share. We've done it in the past, but we'll come back and share some scenarios in the impact.
I think these would make some very illuminating charts for the board to see. So we can. I'll show this on. It will also, I think, give you some comfort on the resiliency and robustness of the portfolio structure today too.
Questions? Okay. Item and our next item is a report from our fiduciary consultant, Rhett.
Awesome. It's wonderful to be here with you with leadership again this morning. So just a few brief updates from the consultants corner. So we continue as your consultant to meet with the senior investment team formally, at least every other week and sometimes more often. For about a year and a half now into this revised updated asset allocation. Staff just reported to you how that dynamic changes now working out. Includes your benefit, portfolio benefit over the last 18 months. Heading into really the December and February meetings, we're going to be revisiting and dusting out that asset allocation for sort of maybe not an overhaul, maybe a fine tuning, just given all the changes here that we're hearing from board members and you're seeing as well. As part of that, you, the board, I guess, and staff asked us again to sort of certify investment performance calculation process with your global custodian and bank of record. Did that last year. There's a minimum testing to that and certifying. So we did a diligence meeting with BNY Mellon and staff again this year, just going through their process. So again, there's a memo formally filed certifying the process. On the markets, for your benefit, I know you can read the numbers and many of you follow the markets. I'm not reading a bunch of numbers here. Just give you some salient takeaways that I appreciate from our perspective. So here on the first page, 3 or 4 sort of talking points from our research crowd. Maybe the top headline here is just Federal Reserve. And if you watch the news at all, you don't have to be a finance or investment person to know there's a lot of sort of political pressure right now in the Federal Reserve leadership to do some interest rate cuts. And I mean, it's not just what you've seen, but also we looked at the data. What we've seen would suggest there's more pressure. Job data, softer expected. It's passed. So we worry about tariffs being inflationary. part of what the big beautiful bill is also sort of ease corporate taxes. And so there's an offset there, from an economic, that would tend, if you're trying to forecast inflation, that would ease some of those pressures. At the same time, we hadn't seen this in decades, but last meeting, a couple of the governors. A lot of pressures here going forward. Volatility seems to be the other buzzword, and it's not because we see any right now. Of course, in April, we talked about this, you did, and I've got a slide in here worth 1,000 words rather than me talking about it. What we're worried about is all of the uncertainty, not the volatility that you don't see right now, but the uncertainty. The concentration in the equity market that Bob just talked about, where more than a third of the S&P 500 is just in 7 stocks. And I'll show you what that means through time in a slide. But also just what's going on in global macro events. I mean, like in Europe, for example, and there's just a lot of uncertainty. This can change very quickly. Mr. Thomas is point. So what that means from our perspective is, you're looking to rebalance the equity markets, particularly the S&P 500 and the tech and growth equity seem a little frothy. I know staff and Bob just reported it. Jared did. I know you've been profit taking there, rebalancing the portfolio and some other ideas, work with them, getting some different exposures in the U.S. equity market as well as the international market. So themes there. I think lastly, on this global equity, what we're really saying here is two things. One, to have it, which you do, but the other is to make sure you're seeking alpha. Prior to about 18 months ago, your global equity, particularly on the international side, was indexed. And for us, that is an area that, at least our own research, we've seen that there's alpha or the ability to beat the markets over time. In aggregate, there's a lot of research we could show you to suggest that you can do that. Staff's worked with us. They made a lot of changes there to try to seek out that. And that's what that's getting to. So that's some of our forward-looking stuff. As of June 30th, and again, I know you can read the numbers, but there are 2 or 3 takeaways here relevant to your portfolio. So on the year-to-date column here, I boxed off a couple things in red. So these are equities. The S&P 500, the first 6 months, you could see 6.2. The takeaway is that the market was up 6.2. Like 7 stocks made up of it, 5% of it. The other is if you scroll down to the a few rows below that, 19.4%. The index on that, if you don't follow this all the time, the Morgan Stanley, the EP is the Europe, Australia, Far East. This is a developed market equity index. So it's not emerging markets. It's not U.S. So we're talking about stocks in Japan, Australia, Germany, England. And you see, I mean, this dichotomy, this divergence now between the U.S. and international markets. And if you don't believe me, scroll out to the 10-year number, and you'll see the S&P averaging per year, more than 13.5. This international developed 6.5. So the S&P outpacing at 2-to-1 over a decade per year. Very different kind of market in the last 6 months. What gives? And it's really, if you drill down into this and you look at just local earnings, U.S. S&P 500, and what's sort of driving that market, and you look at these European, Asian markets, what's driving them, it wasn't just earnings. They're doing fine, and so are we. But a big part of this number has been changes in currency. And I'll show you one page and how that impacts. On the credit sort of rates, a couple of takeaways here on the year-to-date slide. I boxed up a few things for you. One, the first index, this is the old Lehman aggregate. So this is an index that's really interest rates. Investment grade bonds, mostly made up of treasuries, mortgages, and some investment grade credit in there. Mostly stuff that's highly interest rate sensitive. So you see it go up in 6 months, 4%. That is by and large interest rates coming down in that time. I'll show you how. If you don't believe me, you look out, say 5 years. We're 4 years ago, 5 years ago, what was happening in inflation, interest rates, you can see that number there for that same index is negative 0.7. So it's been going actually over that 5-year time period, almost negative 1% per year. Just in the last 6 months, interest rates coming down, those bonds coming up a little bit. The next 2 numbers are credit and different ways to look at credit. The 4.2 is just investment grade credit. And so the 4.6 is high yield, non-investment grade bonds. These two numbers, not so much really being motivated by changes in interest rates or the yield curve, really being motivated by changes in what we call credit spreads. All we really mean by that, if you think about the yield curve, or say the 10-year treasury yield, is how much extra return you need to get, say, on a corporate bond relative to that. And so what's impacting those bonds? It isn't that 10-year yield going up on the treasury, it's the changes, it's that delta or that gap between what these bonds are getting and that 10-year treasury. When that gap or that credit spread compresses like it has, we see these bonds go up. When it flows out in times of uncertainty, we see these bonds go down, we see yields in those go way up. And so if you follow it out just like in the last year, you would say this high yield up 10.25%, 10.3% in the last year. So that market right there to us is getting a little richly priced. That's credit spreads. And I'll show you this. That's credit spreads really compressing, coming in. In other words, interest rate going down, these bonds going up. One other takeaway on this is tips. So the PSF has had an allocation of tips, gosh, I guess going back 2008 or so, just as a line item, as an implementation. Some years after that, maybe 12 or so. Liquid assets portfolio. And back then, it made a lot of sense, particularly in sort of inflation protection. But what's happened is two things. One, you built out your own illiquid real asset portfolio, and you merged the fund with all the real estate infrastructure. And so now you're really in a place where tips don't really make sense. You don't need it. Show you here is when I'm boxing up here is this 5-year number on tips, 1.6%. That was during a time of inflation, right? And so you weren't getting as much inflation protection there. You're seeing it generally moving its hand in inflation. But if you look down at the bottom of this page, what you're seeing is liquid, what we're calling real assets. You've got a ton of illiquid real assets, but you can see these indexes moving very differently. As inflation's going up, you can see 12.5%, 26%, 6.5%. I mean, you're really getting some inflation protection there. The good news is, again, you've got a large allocation of this kind of stuff in the illiquid space. So when Jared, the investment team, Bob, and we bring new asset allocation changes, I guess what the harbinger is, don't be surprised to see some. Moving ahead, we talked about concentration in the U.S. equity market. Bob alluded to it. Here we're just showing you, this is the S&P 500. This is the magnificent 7 stocks here that have really been driving this thing. All we're showing you is going through time over the last couple of years is how much of a percentage, 500 stocks, that just 7 make up of that index. And I think I said maybe 6 months or so, a year ago, look just at one of those. Was it really making sense? Tesla's more, and I looked this up myself. I just did a quick Google search to show me all the auto stocks globally in the world. There's Tesla, number one. The capitalization on it was just about $2 trillion. And I went down and added up the next dozen global auto companies. Tesla was bigger than the next dozen combined. And that just sort of strains credulity. It's hard to believe. And you've seen some correction on that. But you can see again, to Bob's point, this concentration just here this year, moving out of April, coming up back now from the end of June. Now, these 7 stocks are getting closer again to that 33-34% of that entire market, which for us, and talking to your team just means profit taking, rebalancing, moving to some other portfolios that are more, what would we say, completely weighted. So you're not so concentrated in this sector, and your team is working. So I talked about.
I want to interrupt if I might. This is, Mike doesn't know I'm going to ask this. This begs the question, from a long-term strategic asset allocation standpoint, is the S&P 500 the right benchmark for us to use in our equity allocation because of that concentration? Should we be thinking about an equal weighted benchmark that's far more diversified of the economy rather than these concentrated stocks? I don't know. don't have an answer to it or anything. I'm just saying it's something we should peel the onion on a little bit.
Can you go back a slide?
Please, we need to go back one.
Oh, that's the wrong one. Anyway, I just want to know. Magnificent Seven, have you got that up there?
The Magnificent Seven, the page before this one. So this is,
If you took that out to the left a little bit further, what's the norm before this?
oh, with the top seven stocks,
Yeah.
yeah, it'll get down, I've seen that before, you know, in twenties. But not 35.
So this is very abnormal.
Oh, it's outside of the norm. Yeah, this is a concentrated market. It makes it difficult for stock pickers and it makes it difficult for asset allocators, you know.
And that's kind of Bob's point, you know, we're in a different world.
From a benchmarking perspective, you know, what Bob's bringing up, and we dealt with this for those that have actually been around, and point more people appropriately that have experience, not just gray hair. We dealt with this. I know Bob and I had to deal with it in the mid-90s. Call, because it had been around tracking this stuff, Japan. Before the 4-decade recession or whatever. International index, I mean, they were 75%, one country of like 26 countries. They were one, like almost 80% of that index. And so the same kind of problem, it was just more magnified. And what benchmarkers did, what the MSCI did, and maybe the S&P will have to get around to this, is putting controls around that. So like one country just couldn't represent that much of it. And maybe instead of an
Yeah,
equal
in fact, for the longest time, they just started making the MSA even ex-Japan.
Really?
Yeah,
Wow.
so it's a whole other animal. And not to say that you wouldn't want some investment in these 7 stocks, but do you want it in this proportion? And by saying the S&P is kind of what we're following, that's what we're doing. And it's an intellectual question that we should, as I said, examine in closer detail as we look at the investment policy.
The math's pretty simple. We're 7 billion in S&P, about a third of that is these 7 stocks. We got over $2 billion of 7 stocks, which traded very high multiples. It's been great. It's sort of the AI theme, because the AI theme set back 30%. Well, it certainly rallied a lot more than that. So, you know, do we have hundreds of millions of dollars exposure to, you know, wouldn't be an outsized move for this stock. So it's just this simple math. You know, we're $60 billion, a lot of money. So the numbers get big. We're $7 billion in S&P, and a third of that is 7.
You'd probably never start to construct a portfolio like that from the get-go, especially since there's 7 of the most expensive stocks. But yet, all in the benchmark, it leads you down that path.
Yeah, pending the academic exercise, it sounds like we're probably gonna take up next meeting, the following one. How do we think about what Red's telling us about what staff is doing to help equal out some of that weight? And what kind of parameters do you have to work with right now?
So what we did, in fact, is because, you know, the policy says, you know, we're investing in this universe of 500 stocks, we can change the weighting. And there's very easy ways to do that, in as much as there's an existing equal weighted benchmark that's investable and liquid. And so we took some of the market cap weighted S&P monies and moved it into the equal weighted. And just that move right there dampens this effect a little bit. And it looked very prescient for a couple of quarters. And now all of a sudden it doesn't again, because the market's just got that irrational. Yeah, but you know, valuations do matter over time. And but as we've seen many times over history, you know, the market can kind of remain irrational and chase valuations for quite a while. So we try not to let that tail wag the dog too much. We look back on what's important to us, that we have liquidity to pay the ASF. And as long as we know we can do that, then we can have the patience to say, all right, this bet might not look like it worked real good last quarter, but intuitively, it's a smarter bet. So let's let it roll.
So in summary, you think, pending us working this out and talking about this more in the coming meetings, do y'all have sufficient
Absolutely.
leeway to manage?
Yeah, absolutely.
So last quarter, I guess I talked about volatility and the fixed index. where I just did it, orally, Bob asked me, like, that was important stuff. You show them a slide, they can kind of see it. And that's what this is. So the VIX, if you watch the Financial News Network in the morning or whatever, any of these networks, you'll see the big swap up there. You're talking about it, the volatility index. It's a real-time implied volatility of the market. It's 30 days forward looking for those that are math equally, if you're not an investment professional. All it is, if you think about a simple algebraic equation, the price of an option, if you looked it up in an investment book, equals a bunch of things, including the price of the security itself, how long until it expires, interest rates, and in volatility. They're all out there in a big algebraic equation. And all you do is you just rearrange the terms like a high school junior would do, and you can solve for implied volatility. And that's what that real-time live index is doing. And it's out 30 days. So a couple things. One is just it's implied, but it's only going out 30 days. It's really a measure of sort of that short-term view of uncertainty. The important thing that I was talking about is I sort of boxed off where it is most of the time, and it's in that sort of 15 to 22%. That's standard deviation. The S&P 500 long-term in real terms, not implied, is about 17%. Where our forecast standard deviation or risk on the S&P is about 17%. What you can see here is right now it's well within sort of that bandwidth. You can see it sort of spiking up in different times. You don't see it here because what we're showing you here is ending trading day. So how does volatility index at the end of the trading day? But if you looked in April, intraday, how it was doing in April, it actually, if you'd been following just that, this chart would have spiked over 50, I think close to 55% in early April. So yeah, there was, which would just suggest there was a lot of uncertainty around tariffs and trade, but it settled back down, as you can see here. There. So there you have.
There's an interesting point on this, Rick, and I talked about, we know a crisis will occur in the future. What we don't know is from where it'll emanate. And every one of these spikes is very interesting. You almost see the VIX kind of almost downtrending, and then the unforeseen thing happens, and you shoot way out of line there. You see the the COVID spike, the Lehman default spike. You see, and it's kind of it's an interesting barometer for somewhat steady and trending markets but you still can get caught out. And that's why you want to have the diversification that we have and model the cash flows. Sorry, Brad.
What was the spike with the tariffs? Was that April? Is that on here or not? This doesn't go out that far.
It is. Yeah, this goes through June 30th. Of this year. So it is on here. Yeah, what's interesting, I'm saying, is because this is just closing day prices, a lot of they got washed away. So yes, if you were just following it intraday, it did spike up over 50. So you don't see that here because this is just closing day prices.
It's just a function of time. There wasn't enough time for it to show up. It's intraday. They're not, it spiked in the day and way high and came right back down. Well, all these other ones are, COVID, many closing days, it showed up. It'd be interesting if you can show like intraday, but I don't know how many more spikes you're going to have like that only impacted within an 8-hour period.
Probably the important point that I was making last time is just how much uncertainty was out there just for a few days, at least that day. Went over 50, which there were only two other instances in closing day prices where it ended like that. One was great financial crisis. The other was February pandemic, and people didn't know in context just how great it's early April. People felt
Just one day.
it was.
Just interesting.
So, I think some traders got away from themselves and then people settled.
And Brett, quite frankly, the administration put a pause on tariffs to negotiate. So I suspect that probably had an impact as well.
Big impact. One note on, because I know the hook's going to come out here from staff to get going. One note on international equity markets, because it is a big part of your portfolio. And I talked about currencies and impact. Just one point here, I boxed off for you. So this is just the return for you here in the second quarter. What I'm boxing up again, this EV index, again, that's the Europe, I'll show you for you. This is like the S&P 500, for international developed stocks. There were 1,000 stocks in this index. So the way you would read this bar chart is the black bar. First part of this bar is just the local returns. You were sitting in Germany or somewhere in Europe. This is what this index earned locally if you were owning it. 5%. There were no currency. So that would be US S&P 500 earned in that time period. The light blue bar above that is that now you're a US investor and you're translating euros and yen, pounds back into that depreciating cheaper. You're buying a cheaper dollar because it's depreciated. The light bar, over 6 percentage points there of additional return because of that. And then the total return becomes that little diamond. The important takeaway here is you can just see it across the board. It just didn't matter whether you're an emerging or developed country. I think with the exception of China, there were currency depreciation impacts positively impact your portfolio. You can be jingoistic like I am and patriotic and not want the dollar to fall. But from this portfolio's perspective, it's like, at least in that short time. So 2 pages on the spread, and we'll finish up here. So one on the yield curve we talked about. I know there's a lot here, so I'll quickly simplify it here for you. So if you looked at the bottom here, darkest, this is where we are June 30th of this year. And all the yield curve is, we're just taking, how's up June 30th this year? We just took, what was the yield? What was the interest rate on a treasury, 30 days out, 60 days out, 90 days out, went all the way out 10 years and beyond. And we just plotted those. That's what that dark line is. How's that June 30th? And we compare, if you look at the really light blue line, where we were 1 year ago, what you see in like the 10-year time period, very short, all the way to about 10 years, you can see that curve shifting straight down. That's interest rates coming down over that year. You can see that middle line, that's the same thing. That's where it was 1 quarter ago. So you can see interest rates coming down over the quarter. You can see they're coming down over the year. Interest rates in this come down. Again, for those investment grade interest rate sensitive bonds, they're going to go up. You saw that. You've got a big part of your portfolio that was positively impacted by that. The interesting thing is, I'll put you a little dotted green line over there. As you go out beyond 11 or 12 years on that yield curve, it twists. It goes the other way. Interest rates actually aren't going down there. So if you go out beyond 12 years, actually interest rates have been going up. And so what's going on there? And people have different theories, but in terms of what traders are trading on there, but it could be the Ds, the deficits of the debt long term. The deficits are still in this country going up, the debt's going up, and long term, and that's what is out here. People worried about inflation, debts and deficits long term. So yields on those long term treasuries continue. I've been on the yield curve. 1 page on credits and credit spreads that I alluded to, and we'll finish up. So a couple things I boxed off for you. High yield, both of which you've got exposure to in this portfolio, both of which have been just making you a ton of dough. So a couple things. The yield here, we call it yield reverse. That just means from an option adjusted perspective, the worst case it's called conditions. What yield would you get? And you can see for high yield non-investment grade bonds as of June 30th, a little more than 7% on that. Importantly, the spread that I talked about. So again, you take that yield, that treasury yield, and you add some extra return to that. It's about 290 basis points or 2.9 percentage points. That's below average. I think Mr. Thomas is asking, about averages here. Well, look at that long term. It's closer to, about 400 basis points depending on what time frame we're looking at. So that's lower right now. So there's, there could be a little richly priced in there in those bonds. The other part of the market that we look at, we don't call them bonds because they're really loans. They trade in the same place, just a little bit differently. Now they're still high yield, but the same concept applies here. See that spread? Kind of tight. It's either yield on them a little higher. You've got exposure to both of these, made a ton of money in them. We'll be revisiting asset allocation and talking about those over the next 3 or 4 months, 5 months. So I'm gonna take a breath and see if we got any follow-up questions.
Yes, sir.
Just on this one, on the high yield, I don't know, you or Jared, what's the default risk? So as these are down to the triple C.
Yeah, so in that index, there is, 18%, I think, or so left of triple C's in that index. So there is some there. But when you ask for risk, it's been nascent in terms of experience here recently. And that's because credit spreads have come, people are doing really good and people are paying their bills. And so there hasn't been a big problem. The problem is going forward with the concern, whether these are just too richly priced. If there was, problem economically, whether some of these corporations continue to pay their bills and pay these bonds, and then service the debt. And so now the question, I think, the implied question is the real forward-looking risk. That's a different question, not the experience, but forward-looking risk. And what we'll be talking about in February in terms of, we've been taking profits, and redeploying those. But if things continue along this trajectory into asset allocation, we could have some things to say about potentially carrying some of these back.
Thank you.
Anything else? Thank you, Red. That's all.
I think, yeah, we can cross the threshold.
Thank you, APC, for sponsoring last night. Great. Great visit with your CEO. Happy with his passion, so. We're going to give just an overview of the equity asset class. Erin Weedle.
Hi, everyone. Very nice to see you all again. I'm Erin Weedle. I'm the head of our private equity program here at the PSF, and I'm happy to give you the opportunity to, or happy to have the opportunity to give you guys a bit of an update on our PE program. The mission of the program is first, of course, to enhance returns for the overall PSF portfolio. That's a big part of the reason that the board has included private equity in our strategic asset allocation. The private markets grant us access to companies that are not listed on public exchanges, and we've touched on that several times today. That's an ever-growing number of companies that are private, not public. And we often are able to capture an illiquidity premium over those public markets. We seek to outperform or generate excess return over our industry benchmark. And we do this via our core mandate, which is to pick great GPs, our general partners, and we work with them on funds as well as co-investments alongside them. So how are we positioned today? We've got a talented and growing team. We've generated strong performance over the long term. We've made meaningful progress towards our 20% target allocation, concentrating fund commitments with core managers and expanding that co-investment program and those relationships. And we happen to be doing so in an environment that we think is starting to trend a bit more favorably for new investment. So I'll start with the team. We have a team now of 8 professionals, and our most senior team members have roughly 2 decades of experience each. We have 4 CFA certifications, 3 CAIAs, which is a Chartered Alternative Investment Analyst, 2 MBAs, a master's, and a JD on the team. I myself have been with the PSF for just over 13 years. I was at Common Fund Capital, which is a private capital fund of funds, before I came back to Texas and joined the PSF as one of the first hires as we started to build out this PE allocation. Back when we were a 6% allocation to PE and a roughly $25 billion fund. So we've come a long way since then. Marty's been with the fund since about the same time I have, in early 2013. He's previously been at New York Teachers before he joined us at PSF. Joe also came from time at New York Teachers as well as New York Commons, so some very large plans here in the country. Joel joined us from another plan, another large plan, CalPERS, and the California State Treasurer's Office. Tyler's been with the PSF almost a decade now. He joined us from San Antonio Fire Police and after an MBA at Texas State. Tim joined from FMP Wealth Advisors and has his master's from SMU. Aaron also comes from Texas State, and Japraj is a new analyst that we've hired just a couple months ago from Wickdale Capital and Fordham University. So I do feel we've got a wealth of experience on the team that spans decades in the private markets and across the LP ecosystem. And we've also got some very talented, more junior staff, and hopefully you all will have the chance to spend some time with them at future meetings. As a reminder, here are some of the strategies that comprise our PE allocation. We do focus majority on buyout, but we do invest in venture growth and special situations as well. Our allocation is split into two. We have what I call our true private equity exposure as well as a liquid substitute. Each of those allocations has its own benchmark. Our PE is benchmarked against the MSCI Global Private Equity Closed End Fund Index. That's a rename of the Burgess benchmark that we've used for a very long time. And our liquid substitute against the Russell 2000. And that liquid substitute, I know we've discussed that on the private credit side. We have similar in PE, has been filling its role and giving us a next best approximation for the PE allocation as we continue to build out and our commitments are drawn down over time. I'll turn to performance on more of that true private equity allocation across various time periods. And I'll note what I assume is jumping out to you all on this slide, which is the difference between the short-term and the long-term performance. The 1 and the 3 year are certainly underperforming our long-term return assumptions, but not just for the PSF, for the industry as a whole. I would, of course, note that private equity is a long-term asset class, and so it should be judged as such. And over the long term, we're actually outperforming our PE benchmark anywhere from 200 to 400 basis points on that time-weighted return. Compare ourselves not only to the benchmark, but also to our peers. I'm glad we were able to kind of discuss a bit how this chart here comes together, but similar to the chart that we saw for the total fund, this is just for private equity. So that same peer group of endowments and foundations over $1 billion, PE to PE performance for that 3-year rolling time rating. And despite us sitting flat versus our benchmark for that 3-year period, we are actually still just at top quartile versus our peers. I'll touch on that 2020-21 period. We do believe that we were hurt by our underweight to venture. Those are kind of the boom years for venture capital there, really seeing some significant run up in valuations in the venture space. And many of our endowment and foundation peers do have pretty significant venture allocations. So they benefited from that. But as those venture valuations have started to moderate and come back to earth, we do again show pretty favorably versus our peers. So I would say that this illustrates not only that the near-term performance challenges are industry-wide when, you know, a single-digit time-weighted is top quartile, but I would say it also emphasizes just again the importance of that long-term view when it comes to private equity and having the ability to withstand and tolerate these intermediate cycles. The following page is going to be a closer look at our portfolio composition by asset class. We do tend to focus more heavily on buyouts and mid-cap buyouts in particular, where we think there's more operational and value creation potential. We are underweight venture, and I don't think that's unexpected for a plan of our size. Manager selection is super important in venture given the dispersion of returns there. And we do like to focus on smaller checks to smaller funds, which can really make it hard to go overweight a benchmark for a plan of our size. We think the trade-off has been worth it. We think staying underweight the benchmark in order not to sacrifice returns has been a good call, but I just wanted to point that out. The performance can bear some of this out. Buyouts on both the mid-cap and the large cap side have been accretive to the total portfolio. Our excess return and our absolute performance for those two sub-asset classes are higher versus venture or special situations. Graphically, we sit pretty neutral to the benchmark for the largest part of our portfolio, which is North American and global funds. We do have an overweight to Asia, but we are seeing that come down, and we haven't made a new commitment to the region in the last handful of years. And as those managers have come up for consideration, we've really actively been replacing that manager roster with US-focused GPs. Here again, you can see that we've outperformed across these subcategories, and developed markets are performing more strongly for us today, with Asia underperforming our US, global, and European exposure. In terms of the opportunity today, I think we sit in a position of strength. I know there's been a lot of press lately about the state of the PE industry, and not all of it is unwarranted, certainly. But we think several indicators are pointing to a potentially more attractive environment ahead of us. And so we'll touch on some of those trends. In terms of that discussion in the financial press, I mean, we are seeing a lot of headlines about just the slowdown in distributions in the space. So deal activity has been slow, which of course is leading to a bit of a slowdown in distributions or cash back to investors. That's led to a slowdown in fundraising, as many LPs don't have capital to then redeploy in the space, which leads to fewer firms having the capital to again do deals. So we're kind of stuck in this loop right now. I've included a reminder of a typical PE life cycle. Funds typically draw down capital in years 1 through 5. They start returning capital in years, 5, 6, 7. But instead, we're seeing more funds sit on their investments for longer rather than sell them, which is pushing distributions out deeper into an individual fund life. So years 8, 9, 10, or even longer. And we see this come through in the industry data. Hold periods have been extending pretty meaningfully over the last decade, from the typical 4 to 5 years in 2006, just over 7 years today. And we're seeing fundraising decline, dry powder level off. That's the capital that firms have to deploy. And so there's no longer such an open spigot of capital out there seeking deals. So if you put these two trends together, the ratio of dry powder as a percent of NAV, of NAV, net asset value, is the lowest that it's been in quite some time. So that's more companies to be sold than capital available to buy them. And so the supply exceeds the demand. And when we see supply exceeding demand, pricing typically comes down. And again, that's what we're seeing in the data. Median entry market multiples, or the price that a GP is going to pay for a company, have been declining from over 16 times in the 2021 peak to just over 11 times at the end of 2024. And that entry multiple, or not overpaying on the way in, is a critical factor for the eventual return on an investment. And we are seeing that returns tend to be higher on average in those lower entry multiple environments. So I guess the question then becomes, how does this align with the capital that we've put to work? We have kept a pretty steady commitment pace of about $1 billion a year from 2017 to 2022. We started to increase our pacing in 2023 when the combination of the SBOE assets and the GLO assets created a larger pool of capital for our allocation. We then received an additional increase in 2024 at the direction of the board from 15 to 20%. And so we've been investing incrementally more year over year in service of that target. I would note that we've had success increasing our commitment sizes to many of the same funds that have been accretive to our performance over the last 10 years. And we've been able to access new managers as well, and many of which are historically pretty high demand managers that other LPs have had to pull back from because of their own over allocated or under distributed position that we're not currently experiencing. And so that's allowed us to make pretty strong progress towards our 20% target. We are planning to step into that full target a little bit gradually over time. And we'd hope to be at about 17% at a minimum going into 2026. We're actually slightly ahead of that goal, given some of those new commitments I've mentioned, some secondary commitments, and of course, deeper engagement with our strategic partners. So we've been underweight in a somewhat frothy environment, which we think might actually serve us well going forward. And a lot of the commitments that we've made in 23, 24, and 25 are now ready to be put to work in this hopefully more moderate valuation environment. One thing I'll note, and Bob has touched on this, but even at this new allocation, we are still underweight our endowment peers. We're approaching the 20%, but the same peer group that we've been referencing sits at about a 30% average allocation to PE. So all in all, I think, what I'd like to communicate is just that PSF, I think, sits in a pretty unique position right now. I definitely don't want to imply that we don't care about getting distributions back, because we certainly do. But we haven't been backed into a corner by the distribution slowdown in a way that a lot of our peers have. We still have capital to commit. We can be really picky about choosing the best opportunities. And so again, I know I've said this before and I don't mean to beat it to death, but I do think with the higher allocations to illiquids and privates, the timing for that is pretty good as we look forward to an improving valuation environment. So in terms of how we plan on capitalizing, we're going to continue to focus on our core PE partners and our fund-wide strategic partners. A lot of these partnerships have been set up across asset classes. And so they're providing us another avenue for not only strong fund relationships, but also some pretty differentiated co-investments, which we often are able to do given those relationships at no fee and no carry. We are trying to increase our funnel for co-investment across the board. We've looked at some creative transactions in the retail space. We're co-investing directly alongside some of our GPs. We're exploring deeper relationships with certain third-party providers to access kind of an even broader array of companies. But again, I'll say that our key expertise is really in hiring fund managers. And so whether we're seeing deal flow from a fund or from our own networks, we're kind of looping in our GPs and leveraging them to underwrite these deals. And lastly, we've touched on venture a little bit, but we're thinking about refining that approach, whether some of those industry and benchmark dynamics that I mentioned merit a separate allocation within broader PE. We're working on that. And again, I think in December, that will be one of the topics that we look to discuss with you. I'm happy to take any questions or touch on anything in more depth.
Ray, when did we first get into the private equity?
You allocate or had a targeted asset allocation, I think going back to 2008. And then started the first commitments. Aaron, wouldn't have been like 2010?
Correct. Mm-hmm.
You were kind of late in this.
To 2 years. Oh yeah, 2 decades.
Type of private equity back then, I mean, was it oil, was it heavy oil and gas?
No, I mean, Aaron gives you got to hear off from that.
And before the PE allocation, I mean, that was.
No, the initial, like, where were we in types of private equity?
We did actually, so as we came into private equity being more in the 2010, 11, 12, that was post GFC. We actually had a bit of a higher weighting to more special situations funds. We actually were able to see some pretty interesting opportunities given that dislocation post GFC. But since then, a lot of those more distressed trading strategies, it's not been a good time to be a distressed player in PE for the last 10 years, given with the trend of the markets. So we've really shifted since then into, really buyouts all along. That's always been our core focus.
Sure. Didn't we have a statutory limitation from doing that for a long time?
Yes, actually, I believe we did it up till probably 2000-ish or something like that. There, I think we had some limitations. If you're way back in the 1800s, we were limited to government bonds.
We were late in the game, so it didn't have the option to play in the game.
Right. Yeah.
And that is a major part of the explanation of permanent school fund has lagged our endowment competitors, if you will. We are fixing that. That's the peer group, and high level for private equity. We are in a good position. We have dry capital when other people are dry powder when people don't have it. So we're able to strike keener deals. We've emphasized the strategic partnerships, and we've been able to add in co-investments to it. So the environment, we have capital, others don't. That plays to our advantage as we build towards a better allocation of private equity. We still think there's an opportunity there. One of the challenges of that opportunity comes with J-curve, but this is a 180-year-old permanent capital fund. So years of J-curve are well worth absorbing to get the long-term outperformance that ultimately benefit the school children. So we feel good about where we are in the environment we have, our dry powder, the opportunities that we're seeing, and the ability to use strategic partnerships and co-investments to compound over the next few years.
So we're at 17.5% today, and we're at 30% drawdown.
17.5 to the 20. But it
To a
appears
target of 20, and and we will have a good debate about where that should go. I would argue it should be going up. We'll want to work with the board and understand the asset allocation and discuss that. Maybe December, the one after that, but ideally December, it's a pretty unique opportunity and we're in a good position to take advantage of what's gone on in the industry. You know, we're fortunate, I think, that we're a little behind.
Sure.
What were you thinking about with the 30% drawdown?
So the allocated capital, do we have all of our capital allocated? 30% or what?
No, I think the 30% was what our peers are
Oh,
allocated.
Yeah. I think we'll recommend going to that level. We're at 17.5 on our way to 20. And the question will be, should we have a 5-year plan to get to, say, 25 or so? And is the environment conducive for that? And that is for, I believe, the next group.
Sure. A few questions here. Thank you, Aaron, for being here.
Yeah.
So thinking about the dry powder as percent of NAV slide and the increased hold periods. So I get the supply demand dynamics, multiples are coming down, that all makes sense. But who's the buyer on the exit side and how are y'all kind of thinking about it?
Yeah, we kind of consider there's a bit of a have and have not, right? There are still funds out there that can raise capital, that have put up really good numbers. Those are the funds that are still raising capital, the kind of funds that we're committing to. So there are some buyers out there, just not as many, right? So we are focusing on kind of firms that have showed that consistency of performance over time that we feel are obviously going to be a going concern, as we invest in their new fund. But no, I think it's across the board. I mean, we've seen some of our managers in the mid-cap space be active in selling, up to some of the largest players that you would have heard about, KKR, Blackstone, et cetera. Those managers tend to trade amongst themselves a bit as well. So I think it's the haves that do have capital that are going to see seller expectations have to reset going forward.
My thought, I think, is in line with yours too, is that if you can co-invest and you get out of the blind pool risk and you understand the assets specifically, you may just be okay holding those assets longer term because you don't need to be compelled and don't have to face the incentives that the GP faces on, their IRR hurdles to exit. That's my thoughts.
We do talk about that and the fact that obviously as a permanent fund, we do have a time frame that can be as long as we need it to be and whether there's interesting opportunities to take advantage of that.
Yeah, that makes a lot of sense.
And that is what, when we talk about building out a capability with new directs, those are the types of investments, things we would want to hold for longer periods. And in a buyout where there's a remodel the balance sheet, there's generally a period of time for that. And then the PE firm sells business, right? And that is alpha opportunities to fix and sell. There are other growth opportunities where we don't want to be limited by an 8-year period. We may want to hold something for 20 years, and we have the ability to do that. I think two big open issues for the PE business are, one, does the buoyant equity market lead to new IPOs? Does it open up? Right now, what's led it is 7 names, right? But as the market does surprisingly well, we may see the ability for people to sell into it. The second interesting possibility is that retail is allowed entry into some of these markets. So you can imagine if 401ks are opened up to private equity, that would be a feeding frenzy and an enormous amount of capital chasing returns. That's not going to happen over 6 months or a year, but it is possible 2 or 3 years from now, we could have a wall of money coming in. We have a window when we're the money, right? So I think it's important we look at that, take advantage of it, and be sensitive when we want to use our balance sheet for longer holding businesses that are going to grow over a 10 or 15 year period, as opposed to private equity managers who are looking to fix it.
There's a challenge to doing that. You've got to really try to, almost have control of the underlying company itself or have it in a sidecar altogether. A lot of the co-investments are typically top-offs of something in the fund. So the company's still kind of bound by that contractual, liquidation. Maybe you can buy it out of the fund later, they just have to have some valuation metrics in place to do that properly. But, ideally, what you get are, you've got a sponsor-driven sidecar that's unique to that company, that's not bound by this contractual. You own it and you sell it when the economics dictate.
Got, one of the questions is that this is a little bit of a preview for moving forward with asset allocation, because we do need to revisit that. But yeah, kind of talked last time, we talked a little bit about fixed income, but also some private credit. And then we're looking at the private equity. And so I think this is a little bit of a preview for
I have another question. I promise I wrote this before Rhett's slides.
Okay.
On slide, let's see, paginated, page 12, talk about the composition by geography. So how do I think about the Forex risk in relation to this?
I think that's a big part of the reason. Well, one, we have a lot of our portfolio in USD focused funds, right? So even if the underlying investments are being made in a foreign currency, if that hurts the underlying kind of performance, we're not paying the GP out on foreign performance, right? It has to get translated back into dollars for us. And so we are paying performance fees on USD net returns to us because that's what we care about, right? We care about getting our money back in dollars. But on the other hand, there's a 10-year funds, right? So there are certain companies, Japan, not as much lately, but historically Australia, where the currency depreciation has really hurt people on the USD side. And so that's a trickier conversation for us when we think about going into a 10-year fund. But for Europe historically, the 10-year life of these funds, they might be investing when, exchange rates are here, they might be investing, like it kind of comes out in the wash. I hate to say that, but over 10 years, you kind of see that neutralize a little bit. And we're just not as subject to the near-term fluctuations given the long-term nature of the asset class. So like I said, there are certain countries and regions where going into the underwriting, we really do feel like we have to be more careful about the trends that we are seeing over, multiple years. But for the most part, so long as we're investing in USD over the long term, it's not something that we think about on a super short-term basis.
All right, to think that it would potentially affect how the GP would structure their term and extensions thereof, because they're probably, if they're paid out in US dollars, they're aligned with us and want to maximize return. So they want to hit that window so they don't run into a tariff wall or something like that.
Yeah, it's a fair question. I don't know that we've seen anybody seem to like artificially hold back from an exit because the exchange rate didn't seem as favorable. I think for a lot of these smaller firms, if you've got the right buyer, whether it's a strategic or another private equity firm, you kind of have to take that deal when it comes to you. So we haven't really seen people gaming the FX.
So one of the other effects I was thinking about on multiples could be the debt markets. And I don't want to get off into a private credit discussion. I know that's where a lot of the funding is coming, as Bob mentioned earlier, 8%. But what's going on there? And really, I'm just trying to tee up us to think about this and what we want to do in the future on PE.
Yeah, I think a lot of PE firms still are accessing, debt through private credit, direct lending. People are certainly, high quality companies can still get pretty reasonable amounts of leverage. I think it's a big part of the reason why exits have slowed down, right? When you're thinking about refinancing a company at a much higher interest rate than, you might have had the opportunity to do so, 4 years ago. That's a hard decision for people. And it really makes you focus more on the, let's say, underlying operational kind of EBITDA improvements that you can access versus the financial engineering of it all. I do think, we touched on this briefly, if we do start to see some interest rate cuts, I do think that will kind of encourage people to, get back into the market a little bit more quickly. I think a lot of players are kind of hoping that that's on the cards. We've been hoping they would, maybe not be waiting this long. But it would be a bit of an accelerator to exit markets picking up.
Probably increase valuations.
Yeah.
Thank you, Mr. Chairman.
Anything else?
Thank you. Couple questions. One is, you mentioned, I think, funds and managers. Are you investing more in funds and managers, or are you making direct investments? You do both? Kind of what's your mix?
So when I say, sometimes the terminology is a little tricky, when directly into managers, right? So we're investing in funds. We're not investing as much into fund of funds, right? So we're interfacing directly with the GP. We're committing to their fund series. The co-investments are what tend to be directly into companies alongside those managers. And to date, do you believe we've done all of those alongside? Maybe there's been one that hasn't been alongside an existing GP or a third-party partner. So we're not kind of at this point. I think this is something that we're talking about with the build out of a team, and to the point we were making about long-term holds. I think that's something that we certainly could consider, whether we want to go into companies directly on our own without a GP alongside us. But today we're primarily investing in funds, and then there's another, let's say 30% of the portfolio that goes into co-investments alongside that.
Okay. And I know we're going to come back to this. So I don't know if you, on slide 10, can you just kind of define large cap buyout, mid cap buyout, and venture growth? Sentences, and then I know we'll have more time.
Yeah. So the venture funds that we invest in tend to be, $100 million to $500 million funds. We really think it's important that any given company within that fund, if it is a breakout performer, as you would hope in venture, can really return multiples of the fund. So we focus on much smaller funds there. Our distinction between mid and large cap buyout is at a $5 billion fund size. So for large cap, for us, we've got a small handful of those, but we really are talking, 15, 20, $25 billion funds. And mid cap is going to be $1 billion to about $5 billion.
So that's the fund size, not necessarily the target company size?
That's how we think about it. Yeah.
Okay.
Yeah, that's correct.
So they could have overlap in terms
They
of
could.
the same.
Mhm.
Okay.
They could.
All right. Thank you, Chair.
Good. Okay, board members, we have two big items of business we need to kind of run through. And we'll get to them because I think these are really important. And we've had a lot of good discussion, but we need to go to the next item of business is the ethics policy. Something we've been working on for some time. We did have a work session on August the 7th as a handbook through this, and so the documents that you have, you've got a couple of documents. You've got the policy that was on the 7th. And so I think that is then the basis for, essentially that's our starting point for the document. We haven't actually gone through a formal amendment process. And so reflect the conversation, getting back to staff. And so I think that is a starting point. We do have some a summary document for the 6 pages. That we're going to take up because those are some amendments that were submitted. Those included, and they have these, but again, those are okay. And we'll boost the matter done on that and just introduce to the board, and then we'll start with the motion and then work. Okay.
Thank you, Mr. Chairman. Thank you, board. I want to just set the context a little bit. I think the way maybe I had previously presented these red lines was a little bit ham-fisted, and it gave the impression that I had exercised editorial discretion to reject ideas and concepts out of hand. That was not my intent. I think it's important that we have a robust discussion and consider everything that's on the table. And so pleased to report that Director Hickman and I had a very fruitful meeting last night. We did not reach agreement conceptually on what the policy should reflect, but we understand where each other is coming from, and we have, I think, what I can characterize as a philosophical disagreement. And so we can get into that a little bit. The way to set the stage might be with this summary chart that's on page 79 of the diligent. Just to set the stage, and of course, Director Hickman, jump in. I don't want to speak for you. The way the document that was presented last week in the existing ethics policy is written is that it sort of focuses on groups of people or entities. And so if it's within the scope of something that the board does because it's a director or it's the CEO which the board hires or it's a service provider that the board selects, currently the board would address those conflicts. If it's related to an employee or a service provider not selected by the board, or to an investment where the CEO is authorized to make those, the CEO would address those conflicts. And so that's one way you can do it. Director Hickman slices the onion a little bit differently, and he draws lines and circles around a sort of risk-based, high impact versus low impact, regardless of the folks in those boxes. And so it's just different philosophically. And so what the summary chart reflects is how that concept would flow through into the document. Specifically, it starts in section 202 and 203, and we can go through these. But the way it's laid out, option A is what's in the document we sent last week. Option B is what I would call the Director Hickman proposal. In a high level summary, it's just, it draws the lines differently. One thing that would be a new sort of different process would be the role and the function of the Audit and Ethics Committee. So that committee currently, like the other committees, is advisory only. And that means a couple things. We can meet, we don't have to post an open meeting under the Open Meetings Act, because that committee doesn't exercise any of the board's authority really to do anything. It makes recommendations to the board. Under Director Hickman's proposal, that would be more of an authorized, empowered committee. The board, I think, would assign authority to that committee to address and consider and decide conflicts. And so that would be a bit of a change from the way we've done things. And so we would want to think through that and how is that authority assigned, et cetera. I'll pause there. Director Hickman, I tell you what I want to do here. Sure.
I don't really want to go specifically into that specific amendment at this point.
Okay, sorry.
Yeah, we just need to introduce that. I mean, kind of process. And then,
Can you speak up a little on that?
I'm sorry.
I know your voice.
I'm sorry. I'm struggling a little bit. I apologize. But what I want to do is that let's get a main motion on the floor. And then what I want to do is we're going to get a main motion on the floor, and then I'm going to take up those amendments first. And then we'll talk specifically about those proposed amendments. And then we'll go back to the documents to see if we have any additional amendments. Okay. And then when we get to the end of all of that, this board can take several different ballots. We can adopt the policy as amended, or we can postpone it and give it ourselves some more time. Okay. We can.
One more time, a made amendment on the floor.
We're going to have a main motion first to adopt the policy.
Before we discuss it.
We have to discuss it. We have to have a main motion.
Really?
We do. Yes. And then at the end of that discussion, we will have this board can dispose of that motion in a variety of ways.
I'm sure you're right, but that sounds weird.
Okay.
What, I'm sorry, but these have options in them. So what's being, sorry.
That's weird. Down boy.
Yeah, exactly. These have options in them. So
yes,
what are we adopting?
Yeah. Okay. So the option for a work session. Option B is for member Hickman. And so what we're going to do, motion on the floor, and then we're going to open it for allow member Hickman to make his amendment and to make his case. And then we'll decide what we want to do, how we want to dispose of those amendments. Right.
I think maybe the disconnect is you put forth the motion, but you don't it's just out there in the ether, and you don't dispose of it till you get to the end of the discussion.
Yeah, that was the missing.
Right.
Okay.
Yes.
I understand.
Just parliamentary law.
Got it.
So let's get it on the floor.
Mr. Chair, the board adopt Texas Permanent Fund Corporation
ethics policy.
Okay, I got a motion in a second, okay. Now have the main motion.
Point of parliamentary inquiry.
Parliamentary inquiry.
Is that option A is the main motion?
Yeah, option A is the main motion. All right. Hickman's,
No,
option B is, and so.
Got it.
I'm gonna recognize member Hickman at this point.
Just, can I ask one question before we get there?
Sure.
Are we, is that the primary open item coming out of the board, of the last board discussion? Is that why we're focused on it, or is it just the biggest?
Well,
The biggest change that's out there that we.
those are the amendments we received ahead of time.
Okay.
And so we're gonna, being that we received those amendments ahead of time, we're gonna take them up. And then we'll go back to the document to see if there's any additional amendments. Okay. Mr. Hickman.
Mr. Chairman, I move to substitute sections 202, 203, 302, 501, and 502 as option B as presented in our board book.
Okay.
So there's 5 sections. I think they're marked in blue.
Okay, we have a proposed amendment. Is there a second? Okay, we have a motion in a second.
Thank you. First, want to thank Lane and Melissa working late with me yesterday to present option B. It's shown in blue in the book. To Bob and the team, I just want to say I've seen nothing but professionalism and great results since I've been watching and since your arrival. My questions and proposals are what I'm trying to do is create the best governance structure in my mind. So I think Lane, thank you for teeing it up and the email and working with me to get us here. I would just say from my point of view, there's not a right or wrong answer. These are different ways of I guess slicing the onion, what you said. My proposal seeks to empower the committee to be more involved with high impact issues. I think these would be high value, high impact to the PSF and very infrequent. It's proposing a different level of delegation and dividing up staff versus the ethics committee or the board's roles, and just a different governance model. So if I could start with 202B, this the reason I did all 5 together is all of these flow together, and how this starts out in disclosure, and that's packet here, so I'm reading from the right page 4 of 19 is what I have in 202, option B in blue. So there would be a disclosure. A is exactly the same. Anyone discloses to the general counsel any actual or possible conflict of interest. And then in B is where there's a different approach. In my proposal, the general counsel would then make a recommendation to the audit and ethics committee of if this is a high or low impact to the interests of the corporation. And then where this flows throughout is low impact, stay with the general counsel, the CEO, PSF staff, and high impact would flow to the audit and ethics committee.
Can I ask you?
Yeah, I was going to pause there. So that's
Just
great.
on that, is high impact and low impact defined anywhere? Or is there a way to define those? So the specifics of what that.
I'm open to defining that, and Lane and I discussed a little bit. I think it's the way it's defined in the process is that it would be as defined by Lane and then as agreed by the audit and ethics committee. So if the general counsel says this is low impact, audit and ethics agrees, that's B1, it's low impact. If general counsel says it's high impact, audit and ethics agrees, it's high impact. So it's as defined by the general counsel and agreed by the audit and ethics committee. So it's up to the audit and ethics committee how often essentially they would want to be involved in a high impact.
That should ever go before the full board or just with the audit and ethics?
I'm open to, I said it as Audit and Ethics Committee being the decision maker. I'm open if we want the full board. I think some of these may have a shorter time fuse. It's easier to call the Audit and Ethics Committee together if there's an issue. But I'm open if, maybe that would be a secondary amendment. If we want to replace Audit and Ethics Committee with the full board and having then a 3-step process of general counsel making a recommendation to Audit and Ethics, who would make a recommendation to the full board. I just thought it was simpler, faster, easier to have Audit and Ethics acting as the decision maker based on a recommendation from the general counsel.
If I may.
Yeah.
This touches on a practical consideration, which is we don't post and notice the committee meetings currently. And I think under this formulation you would. And so, we just need to think through that, aligning calendars, posting the notice under the Open Meetings Act, and how does that interplay with speed of execution around investments and other decisions. So just keep that in consideration.
What I was thinking, and Lane, correct me here, is it would only be a posted meeting of the Audit and Ethics when they're deciding. So it is probably be a special meeting. I don't know how often these come up. I'm imagining not very frequently, and high impact even less frequently. So whenever there was a high impact, the Audit and Ethics had to act on, that would be a posted meeting. Everything else on the agenda would remain as unposted kind of normal meetings.
We definitely want to research that. And so like if you're making this decision point, is it high impact, is it low impact? Do you have to post that? I don't know as I sit here, but we'd want to take a look at that. Sure.
So Mr. Chairman, the approach is that what you're proposing would engage the Audit and Ethics Committee in rather than being informed for the most part.
If you look at 202B, option A, it's the general counsel determining whether the disclosed relationship could reasonably be expected to diminish, blah, blah, blah. So it's the general counsel making the determination, and then there's a report to Audit and Ethics. What I'm suggesting is having Audit and Ethics act in a decision-making role, and it's a different delegation. So that's, like I said, there's not a right or wrong answer. I just thought the Audit and Ethics for those tip of the iceberg, high impact, high value issues, bring the Audit and Ethics Committee in to the decision-making process.
Okay. Can I ask a question? Does this pose, maybe I'll ask it a different way. It seems like this adds like another layer of, I guess, checks and balances. However, when I'm looking at it, I'm trying to understand what we're trying to solve for, because I feel as though if we have a general counsel determination, that I would hope, right, best practice is that's an impartial decision, right? It's non-subjective, it's a very objective decision. Where I have a little bit of concern with something like this is that should one of the directors that's part of the A&E committee be a part of the decision-making process, doesn't that create some even perception of like partiality, right? Like I'm a little concerned with that.
Say that again.
So if there is a member of the A&E committee
that's the target,
that is the target,
then it's built in. When you get to the decision making, I don't remember which section, 501, 502. Pick on myself. I'm on Audit and Ethics. If I'm the target of the problem, I'm not involved in the decision making. It would be Dr. Ellis and the remainder of the board, or the remainder of the Audit and Ethics would decide about me. So I'm not, if I'm the target, I'm not involved in decision making.
I think for a more consistent way of approaching this, should it happen more than once, doesn't it just make sense to do a clean process where general counsel is the determinant? Right. I just feel like it creates a level of consistency for operational purposes that I can get behind. So I don't necessarily know that I'm fully understanding why this is necessary.
Joel, question. So it's the current construct is that no committee over any subject is authorized to vote or make a determination.
Correct.
All matters in committees are technically advisory and they're brought to the board. So this is like, we're sort of cutting something from whole cloth for this narrow issues. That's kind of where this would have to go.
Correct.
Is that right?
To that point, would bylaws need to be changed?
I mean, I think as drafted, it is broad enough to allow this. 501 says the board or chair may designate committees of the board that shall have and may exercise such powers as designated by the board or the chair as applicable. And so we could, I think, but we just have to be clear about that delegation and how that committee is composed. And is it, if there's 3 people on the committee, then 2 is a quorum. And then so you've got 2 people exercising the authority of the full board instead. But then if you put 4 and then you have 3, but you don't want 5 because then that's a quorum of the full board. So we'd want to think through that.
So, and on the open meetings question, so I'll just ask it open-ended. Would this mean that if you have to post the meeting, that these issues inevitably are in an open meeting?
At least to an extent. And so you'd have to put yourself into an exception for executive session. And I guess it could be, there's one for personnel matters. There's one to receive discussion and briefing around investments. There's one for attorney-client privilege. And so I guess the way it would work is if you fit within one of those, you could go in and you could discuss the issue and then you'd come out with a motion, based on the facts discussed. We determine that this is a high impact or low impact
but it would mean the entire meeting has to be open, other than this issue becomes an executive session of the committee meeting.
Yeah, you can't make a decision in the executive session.
But I mean, the entire agenda of that committee meeting would then become an open meeting.
Correct.
Unlike any other committee.
Correct. Well, I mean, I guess the A&E committee, so if the meeting is like, we convene the meeting to decide whether this fact pattern is high or low impact. That would, but presumably the A&E committee still does the things they already do, right?
Well, I guess my question is, if this is sort of like an irregular occurrence, then you would be having not open meetings for your normal committee meetings.
I see.
And then every once in a while, you would post this meeting that really isn't going to be an open meeting. It's going to be an open meeting that goes directly into executive session about a topic, and it may last 10 minutes.
Yeah, I take your point. Now it's easy because it's black and white. They're advisory only, none of it's open. And once you do empower the committee, you're living in the gray about the fact pattern of, well, what did you actually do at that meeting? And did somebody accidentally make the motion and didn't post it, et cetera?
Any other questions, discussion?
I have one more.
Yes, ma'am.
So, yes, if we go with this option B, and the committee meets an executive A&E committee, meets an executive session, makes a determination on a high impact.
It's hard to hear.
Oh, sorry, I'm so sorry. I'm thinking through my question as I go. But if we go with option B and the A&E committee meets and makes a determination on a high impact, let's say it's having to do with an employee, is that making an adverse employee decision on the committee versus CEO?
It could be, yeah. And so we want to think through, liability coverage and, retaliatory accusations and protected classes and all those sorts of things. You're taking, the CEO wears that risk currently. And so we'd be sort of spreading that, at least in certain instances. And so we would want to think through.
Would that only be to the A&E committee members, or would that be because they're acting on behalf of the board, the full board?
It's It's a good question. I don't know. We
Can I respond?
sure.
My intent and the way I was hoping to draft in 203E, the employment related sanctions are from the CEO. So the A&E committee would make a determination of, is this a conflict or not? Here's proposed mitigations, or here's options. And then back to the CEO for what to do with that employee.
You just.
So the ultimate termination or mitigation. So I realize I'm dancing on the head of a pin here, but the A&E committee decides, is there a conflict? And then recommends mitigation or termination or whatever. But that's 203E was not amended. So that ultimate employee decision still rests with the CEO.
We're still on 202, right?
Well, the amendment is inclusive of all of those proposed amendments.
Maybe I'm just simple looking at things like this, but why would we be making it so complicated? It just seems so clean. General counsel, whether disclosed facts of a conflict of interest, informs it if there's with the director, CEO, or board. It's like real clean. Now we have ambiguity with high impact, low impact. Like, why would we do this? Sorry, it just makes no sense to me to make it complicated.
Yeah, I guess you could have, I'll pick on some people across the table. Say Bob has a conflict and he goes to his boss to make a determination. So if it's high impact, high value, I see the point of the audit and ethics committee to oversee. I think that's why we would have that committee, is to be involved in a high impact, high value, infrequent type occurrence like that. So it's whether it's an employee, one of us, one of the service providers, that tip of the iceberg, high value, high impact. That's why I've structured this. Like I said, it's not a right or wrong answer. It's just a different way
The
of.
same issue still is in play. You still have the general counsel still going to the A&E committee, but what you're suggesting is a situation that could possibly occur where it gets buried, and so it's gonna get buried in either situation. I don't see this process fixing that.
The difference is it's a recommendation that goes to the A&E committee versus general counsel, staff determining everything. So that A&E committee would be involved in the determination in the decision-making process for a high impact, high value conflict.
This doesn't say the general counsel is going to make it just says could be a conflict. So generally, that's a very low bar. So anything high, clearly what you're suggesting is, I'm not sure it would be even, that's reaching a really odd scenario for somebody to be completely unethical here as a possible normal course of business and make this pretty complicated, because it already says if there's a possible conflict, it gets referred.
It's not referred.
It could be a conflict of interest, promptly informs the A&E committee if the conflict, right? So it's real simple to me. Okay.
We're just gonna vote on this raft of amendments.
Okay, well then I'll just say one more thing. I appreciate, Member Hickman, I appreciate the thoughtfulness. I think this actually dilutes the intent, because there's a couple factors here. Philosophically, we have the separation of board powers and management powers. Ethics are mentioned throughout the bylaws. They flow from the board, and then we can empower the CEO to make the decisions. Our board members, some of the board members are elected. The audit and ethics committee will turn over. So I think that's practically difficult. The second part is just if the issue comes to the committee, then it actually separates the accountability from the CEO. And if it's with the CEO, then the board has the authority to hire and fire the CEO. If it is that big of an issue that the CEO has taken an unethical step,
Right.
then we're in a bad spot anyway.
Right.
It can't just be that one little issue. So I think it's actually moving away from direct accountability into a little bit more of a, a cycle of what's low impact, what's high impact, what does the committee think, recommendations, and then, next thing you know, you're really, I think you're really losing what's black and white about the important topic.
Agreed. Sure. I'd like to thank again staff for the time and putting this together, and thank the directors for the discussion. I'd like to withdraw the amendment.
Okay.
I was just gonna agree with, we also fired the general counsel.
Right.
So that's right.
Next year, that's in the minutes, please.
Welcome to your first meeting. I describe it, we are the next, you are the hangman.
Permission has been requested, to withdraw the amendments. Any objection to granting permission to withdraw the amendment? Hear no objection, the amendments are withdrawn. Okay. We are back to the base document. A good discussion, by the way, and Mr. Shankman, thank you for your diligence and your thoughtful approach. I'm just gonna walk through this document and by section by section, but article by article. I think it's a little bit bigger chunks than what we did in the work session. But I think everybody's had this since about
10 o'clock. Like,
yeah, but I mean, but.
Oh, this one.
The base document, at least since,
Yeah.
so it's been at least a week, right?
Okay.
yes, sir.
All right. So any proposed amendments in Article 1? That is the general provisions. Okay. 2 conflicts of interest. Outside business activities. Yes. Okay. Let's take the campaign contributions. Amendments. No discussion. Article 5, compliance disclosure, enforcement and training. They have the appendix, anything into the appendices. Okay. Amendments or discussion on the document, Mr. Kinsley.
I'm getting caught up. I have the version from yesterday. So I think I'm in section 5.
Okay.
Okay, so right now, I think at the bottom we have the effective date as November 1st, 2025. And I think I was at least one of n number of people who suggested a delayed implementation based on some of the private market transaction things that we had to work through at the time. In talking with Lane, I think we've worked through those. You have a step-by-step guide that can help walk us through what is a conflict, what is not. We've talked about the disclosures that we make with the state that are on file, and the reconciliation and all that. So I feel comfortable with an earlier implementation date. And especially around some of the other things we talked about, which is the referral. So I'd like to make an amendment to the end here that says exception section 205 will have immediate effect and apply to any referrals made during 2025.
Let's put on page 17 under.
That again, one more time. Please.
Page 17, yes, sir. I would like to insert the language at the end that says exception section 2.05 will have immediate effect and apply to any referrals made during 2025.
Policy.
The amendment that I'm offering, Mr. Chairman, is to apply just to the referrals. I think that that's the cleanest one. If somebody would like to make a secondary motion to amend my amendment to make the entire implementation immediate, then we can do that for August.
But your language goes on the very last page, right? That's what you're proposing.
So this would be the effective date.
Which language? I don't see a referral to the date of
Page 17.
17 of 20.
Without them,
Right
page
here.
75 of your
Over here.
Page 75 of diligent.
Keep going.
Okay.
Four more pages.
Where is the
bottom?
where's the bar?
This.
Where's the part of your?
I'm attempting to add in a section.
Add in language.
Here, there. Add in language at the end that makes an exception for the effective date for the referral. Ought to be for
205.
For that.
I need a second, I think.
I'll second it, sorry, ask you a question.
Got a motion, I got an amendment in a second.
You were going back to the beginning of 2025.
That's my intent, but I mean, I'm happy to
Are we
come
able
to change my motion.
I guess, retroactively have a document? I can understand from like today's point, but is there any issues with going back prior to when this document was created?
Well, there's at least a practical issue. We don't have a law. We haven't been keeping a law. We could shake the bushes and see if we could put one together.
My point is, want to be held accountable to something in a document that wasn't.
Yeah. Yeah, fair question. Chuck, I don't know if you have a view on that.
I think. I mean, you could have it apply to that, but I do think retroactive application certainly puts folks who's in a little bit of issue.
Mr. Chairman?
Yes.
I'd like to restate my amendment.
We're saying.
Instead of any referrals made during 2025, I would like the amendment to say section 205 will have immediate effect.
Section 205, immediate effect.
A secondary amendment?
Okay.
Just say,
Just a minute, before you get to that, you seconded the original motion? Okay, so you want to go ahead and second it as restated? Okay, all right.
I would like to essentially say what Director Kinsey suggested, is this policy is effective as of August 21st, 2025. So the entire policy is effective as of today and has immediate effect.
We have a secondary amendment. Again, the first right amendment to not only apply to section 205, but to.
I just have a question, like just curious why November 1st was put in here to begin with.
Well, it was and I received comments without attribution.
Yep.
And so someone had suggested, like, let's make it it's after the fact, so I can take a look and.
Okay, so you're changing your. Got it. Yeah.
Okay. So the second right amendment is to amend the amendment to make the.
Wait a minute.
The effective date apply.
But you get through.
I'm
Yeah. Sorry, so I was just summing up with some questions, so please. Now we're done.
Okay. All right, the second right amendment is to substitute. Objection. Second amendment now is to the motion. to make the policy effective. Any objection to the first recommendation? Main motion. This point, we have a main motion and move on and adopt the policy. Or if you want to do something different, you know, if you want to, I know we're discussion about how you do this. Yes, so sit here. No,
I was looking,
okay,
not raising my hand.
okay.
Yes. I have a question, maybe for Lane. Appendix B, annual ethics policy report. With the amendment we just made, will that be due April 15th, 2026? Or this is a new appendix B?
It's a new appendix B. My understanding is we've been requesting these forms. We haven't always been 100% about chasing and getting them from everybody. But conceptually, yes, that's right. So that'll be due April 15th, 2026.
The first one. Okay, sir. Thank you.
Okay. All right. All right. The motion is to adopt the policy. Support the motion, say aye.
Aye.
Those opposed say no. Let's have it. Motion carries. Exactly. Yeah. Last time I'll do you. Evaluation of the chief executive officer. And, board director. Soon, upon conclusion of the closed session.
Yes, sir.
Okay, the closed session of the meeting. The board of directors of the Texas Furnace Corporation on August 21st, 2025 has now ended. The board is now back in open session. Time is 1:46 p.m. No action was taken by the board in closed session. Okay.
I move to accept the recommendation of the Budget and Compensation Committee for the CEO.
Got a motion in a second? Any objections? No objection, motion carries. Thank you. And we have an update on calendars.
Yes, sir. It really, there's not any change since the last meeting. It's just is in there as a point of reference. Should you or other members, next meeting, we will have Nick Tramontano here to present on behalf of real estate and real assets that we like last presentations.
And I think we'll probably also get a report on proxy voting.
Yes, sir, that's on there as well.
Okay.
And I'm happy to send that out and circulate to the board after the meeting, so everybody has a chance to review it and provide you feedback, sir.
Yes. Do you have any further updates on your committee other than what we?
I can just quickly get, committee met yesterday, reviewed the quarterly budget for the current and the future biennium. Also went through a comprehensive compensation update and heard from various members of the team. That's it. Happy to answer any questions on it.
Questions? Okay, Mr. Kinsey?
Yes, sir. The Strategic Plan Policy Committee met yesterday, 2:30 PM. Heard from Bob, and Mark. We also looked at the ethics policy that we adopted earlier today. We talked about the ASF distribution, the 10-year test analysis for FY 2026. Jared Stout walked us through that. We're in great shape there. Looked at a strategic plan update with Needy. That was her first time to come before the committee as COO. It was a great presentation. And we talked about next steps, which involve a refresh to the strategic plan and what that might look like for new metrics, new measures going forward. And then finally, we closed out reviewing the proposed agenda for the December 3rd, 2025 meeting and the projected calendar for February and May 2026 meeting. No change from me.
Audit and ethics, Dr. Ellis had to leave. I think it's pretty.
It's very, we've pretty much touched on everything already, sir, that we are covered between the updates, the policies.
Yeah, the external audit, we should have a preliminary on the next meeting.
Yes.
And then the final audit report will come in February.
Yeah.
And then, of course, I think that the internal audit's been a lot of work as well. And so.
Yeah.
That, I think, members, thank you. Good meeting. And next time also on the next agenda is the governance manual. So get that one done.